Hello everyone, good afternoon, good morning, good evening, depending on where you are. I would like to welcome you to session 8 of MOOC 14. Today's topic is cryptocurrency, financial institutions, and central banking. I hope you've had a good few weeks with Andreas Antonopoulos and that you covered, and that you covered the technical items well. We are back now in the financial sphere and the financial implications sphere of cryptocurrency. And so I'd like to cover the student questions first. We don't have a ton of questions, and I suspect this was a fairly technical presentation from a financial perspective. And after I cover the questions, we'll see if there are any other questions in the chat. And if there are not any other questions in the chat, I can also cover some topics that I think might be of interest. So let me just fix my camera a little bit. All right, I think we're stable. All right, I'm going to read the questions. First question, be your own bank. Student writes, do you think most people even know or care about a bank if they knew about different basic income pilots? I think this means, do you think most people would even know or care about a bank if they knew about different basic income pilots? And they shared a few links, the basic income token, GoodDollar, and Nimiq, I think that's how it's pronounced. And we'll discuss a little bit what the concept is for basic income. And this is a topic that has come up quite a bit recently in economics. And it is a concept that says something as follows. It's an idea to replace a variety of social spending by government. And it is an idea that says, if you give everyone a basic income, let's say, depends on your country, maybe it's $1,000 or $2,000 or $3,000 a month, you know that this will cover people's general day-to-day life needs. And based on that, you don't have to worry about a variety of different social programs, and you know that everyone has, let's say, a base level of human dignity in their life and what they can spend. And this tends not to be income tested or means tested. So it means that you receive it whatever your income is, whatever your means are, and so that it doesn't have a disincentive to work. So if everyone knows you're starting to get, let's say $2,000 a month or 2,000 euros a month, but if you then also do a job or start a company or sell your art or open a lemonade stand and you get additional income, you don't lose your 2,000 euros, so you still have an incentive to work. And some people consider this to say, well, no, you'll have less economic growth and less economic development because people won't have a motive to work because their needs will be taken care of. But others argue the exact opposite. So others will say, there are many people that might want to start a new business or pursue a personal, cultural, social, or economic interest, but they do not because they're worried that they might not be able to put food on the table, or they can't handle the transition period, or maybe they'll have a medical expense, or they can't pay rent, or what have you. And so the pro-growth view of basic income is something like, you'll see an explosion of creativity, an explosion of new ideas, because everyone knows their basic needs have been taken care of. Now, this is the as of today version of it. There's another stream of thought that has to do with basic income, which is relating to, let's call it the fourth industrial revolution, or let's say the rise of the machines, or the rise of artificial intelligence, machine learning, this is a view that goes something like this. The next 10, 20 years, you will see an explosion of machine learning and artificial intelligences, and they will progressively be able to do a variety of white-collar jobs. And when they do those white-collar jobs, it will not be like in the past where you had technological development and certain jobs go away and people get jobs in other fields, which has been the history of economic development, right? There was a time when 70% of the United States was employed in agriculture. Today that number is 2 to 3% because, yes, we've become vastly more productive in agriculture and it's been mechanized, and so you need a lot fewer people to be farmers. But in the meantime, we've developed positions for web developers and social media managers and accountants and what have you. And so people over long periods of time have been redeployed to other industries. So the theory, this AI sort of singularity idea, is that you will have such a rapid development of artificial intelligence and machine learning that it will simultaneously cover both the existing jobs and the new jobs that are going to be developed. So it won't just be this will handle one aspect of white-collar jobs and people do something else. Many white-collar jobs will disappear at the same time, and then you'll have a lot of people who are unemployed. And even more importantly, and this is part of what the proponents say, a lot of people who will feel some level of social exclusion, right? Because I think there's a belief by a lot of people who are discussing these topics that people like to have a job. Not just for the simplistic reason that when you have a job, you usually get a salary and you can use the salary to go buy a hamburger, but that people like to feel that they're a socially useful member of society. They're contributing in some way. It tends to become, for many people, a huge part of their adult identity. So someone says, I'm a heart surgeon, I'm a dentist, I'm an accountant, I'm a professor, I'm a teacher, I'm a nurse, I'm an astronaut, right? Like that's, most adults have that as part of their identity. And so if you had a large number of, excuse me, white-collar, unemployed, that previously were employed, and it would be socially negative, it would be socially disruptive. There might be effects on people's mental health, there might be effects on people's physical health, there might be effects on society at large. So the idea of basic income is to try and wipe that out altogether for the whole society. And that you say, it doesn't matter if tomorrow the machines have come for your job, or today the machines come for your job, or maybe the machines are going to come for your job in 10 years. Everyone will start off the year with this certain income. And part of what the AI machine learning basic income advocates say is, in theory, human wealth will increase if machines can do things, right? Like the cost of me, let's say someone can do my job, right? They can write my emails, a machine can do my emails and teach this course. Well, in theory, because that's just software, and software has a very low marginal cost, like the extra cost of a piece of software running one more time might be measured in pennies. Well, I can't live my life in pennies, right? Like I need a salary, I need to have a car and feed my family and what have you, right? So the cost of, I'm much more expensive than a piece of software. Well, the idea being, if you can manage to move everything or many parts of the economy to be machine-based, artificial intelligence-based, humanity in aggregate will be much wealthier, because wealth comes from resources that are in the ground, right, times the size of the population times productivity growth being the most important one. Well, machine learning, if machine learning can do accounting and write legal briefs and teach courses, and I leave aside the question of if it can do that. Let's just pretend it can. If it can do that, we will be a vastly wealthier society because the cost of making an annual report from the company will go from being hundreds of hours of expensive human labor to a few minutes of computer runtime. And then people say, well, who's going to benefit from this? Maybe it's Google. They've made this important software, and it costs them pennies to write an annual report, but you'll pay them a good amount of money for them to write an annual report. And so Google wins, but now hundreds of accountants are out of a job. So the concern is that this will lead to greater income inequality. That generally with technological development, it tends to concentrate income. And so the theory for the technologically driven basic income is that we will have productivity growth through technological development. This productivity growth will generate wealth. This wealth will be concentrated probably in big companies. Basic income is a way, in effect, to redistribute this wealth so that everyone benefits from this generation of wealth, and while also moving to a model of, in theory, something very, very nice, right? I think most people would say, and if you look at some literature from 100 years ago, or 150 years ago, 200 years ago, it would be super nice if machines could do these things, and then we'd have a bunch of free time, and we can use it to sit on the beach or read a book or produce art or do other things. Well, that hasn't happened. People new jobs emerge, and people tend not to be satisfied with their material possessions. I mean, if you think about what the average family had in 1960 in the United States, the size of their house, their electronics, their what have you, well, you could probably have that amount of consumer wealth and work 10 hours a week. But nobody does that because they see that their neighbor has a bigger house and they have a flat screen TV and they're going to vacation at Disneyland, and so they want that too. And so everyone ends up working, I don't know if they're working harder, but working still a full week. Well, in the exciting world of should this all happen and machines do all our work for us and are better than us in everything, right? Like the full extreme view of this is that for almost all professions, permanently, computers will be better at us than doing our jobs. So in that world, that's super great. The machines will produce a plethora of wealth for us, but how do you organize society? Right? Today, society on every level is largely organized on, labor costs money, and things have prices, and you work smarter or harder and you make more money and what have you. Well, they're saying, well, that's not going to be as much the case now. And so we should separate out one's income from one's labor, at least at a basic level, right? The basic income. It's not saying this is a cap on your income. It's saying this is your basic income. So you'll come and say everyone gets $2,000 a year. And let's say the machines become more productive. Maybe in the future everyone gets $3,000 a year. And so on. So this is very interesting, right? And I think it's important because I eventually will answer the question, but I'm going to answer the question theoretically. And to answer a question theoretically, we have to think about what the theory might be. The technologically driven, singularity driven, machines will do all our jobs scenario basically says the money to pay for the basic income will happen from all this productivity that society has built. Right? We'll be a much more productive society. Based on that much more productive society, we'll have a lot more wealth. With that more wealth, we can ensure that everyone has a roof over their head, a full 3 meals a day, and so on, depending on how wealthy the society is. The folks who are saying basic income now, most of the counter arguments against basic income are, well, we can't afford it. And then there's sometimes an argument of it's going to cause bad incentives and people aren't going to want to work. Devil finds work for idle hands, all of that stuff, right? But the ones that are not counting on a machine learning AI revolution to order to pay for basic income are the ones who are saying, well, maybe people will be more productive and they'll pursue things they'd be great at as opposed to just taking any job that they can find just to pay the bills. I don't know. I mean, I think it's a hard question to judge if that is actually true, if people will be more productive if they get a basic income. And if the increased productivity will generate enough tax revenue to then pay for the basic income. So there we just don't know. That's a hypothesis. I'm not sure it's true. The other one, I believe it is for sure the case if machines could do all our jobs, we'd be wealthier. There the big question is, will machines in fact be able to do all our jobs? And today the answer is clearly no. And then you then get into this very interesting question where there are very strong opinions on both sides from AI researchers on both sides, where some AI researchers are saying, well, this is never going to happen. We know what the state of the art is on AI, and there's just so much work to be done. If it happens, it's a century away. And there's others that say, well, no, because even though we don't know now, what we do know is that the rate of us knowing is progressing at a rapid rate. And so even though it might seem inconceivable today, in 10 years we'll know a lot more than we know now. But in both cases, there's at least a theoretical mechanism to pay for the basic income, whether you think basic income is good, bad, or indifferent, or whether you believe the mechanism. There's a mechanism being proposed. On the basic income tokens, which I think are very interesting experiments. I'm glad people are running the experiment because we might actually have learnings relating to the token itself, or you might learn things that you can use in society more broadly. The part that is the question for me is, where is the wealth actually being generated in order to be redistributed? Right? Because in order to distribute, let's say we had the Polemitis basic income token, and I said anyone who takes the MOOC is going to get €1,000 a month Polemitis income token. And you guys never have to work again. Right? 2,000. Let's say 5,000. If you take the MOOC, you're going to get 5,000 a month for the rest of your life. You don't have to worry about working. Well, that's interesting. Where's that 5,000 going to come from? Is it that I have 5,000 times 40,000 people, which is 200 million a month to give people? No, I don't. We say, oh no, but the token's going to have value. But for the token to have value, there has to be someone willing to pay for $2.4 billion of token issuance a year. And that's just for the participants of this MOOC, right? And so, I don't know. That's my question. I like the experiment. I'm glad it's happening. I think the theory behind why a private decentralized token should have value is very complicated. I think after a lot of work, there's at least a theory of why Bitcoin has value. It's digital gold, etc., etc. It's a fixed supply, etc., etc. And even then, it's taken a decade and people are still arguing about it. There's still an open question of why Ether has value. People still haven't concluded on that. And so the weak spot in all of these universal basic income tokens and variations thereof is, sure, it's very nice that everyone gets a token issuance, but it's not clear why those tokens in the long run should have value. Now, it doesn't mean they won't. It doesn't mean that someone won't find the magic solution. It might not mean that someone might not find the way to bootstrap the token so it does have value. But I think that's the open question. That's the weak spot in these. So to answer the original question is, well, given there's universal basic income tokens, why should anyone worry about what banks are doing? Well, I think the short answer to this is we don't know if these universal basic income tokens are going to work. So I would not suggest you today say, this problem is solved. We don't have to worry about a salary. We don't have to worry about banks. We don't have to worry about assets. We shouldn't invest in different areas that one might want to invest in because everything's going to be taken care of by a crypto basic income token. I don't think we're there yet. But I'm glad that people are running the experiments. I consider these experiments to be in extremely early stage, highly experimental. We're going to need to see a lot of years of work before any of these come to fruition. It's interesting, like one of the things, now that I've answered the question specifically, I'll leave you with this thought. There are countries that have either a direct or an indirect basic income today. So it's not completely unheard of. On the indirect basis, some of the Gulf nations that have very large oil reserves, it might not necessarily be a basic income, but there are tremendous subsidies to the local population in many ways that, in effect, from the hydrocarbon wealth that they have, you don't fall below a certain standard of living if you're a citizen of the country. Has this led to an explosion of entrepreneurial activity in those countries? I don't think people would say that's the case. Of course, there might be confounding factors. It might have to do with their legal system, with their system for entrepreneurship. So I don't think it's an answer either way. These are fairly young countries with a fairly undeveloped business ecosystem relative to something like the United States. And so I don't think we can draw a conclusion, but for sure the conclusion is not simply, great, everyone in Saudi Arabia or Kuwait or the Emirates has a strong level of social support, so it's become a entrepreneurial hub. I don't think that's happened. There's another variation in Alaska. Alaska people get a dividend check from the oil wealth of Alaska. Would I think that Alaska is a kind of entrepreneurial hub? No, I wouldn't say that. On the other hand, it's Alaska. It's in the Arctic Circle. I mean, there's other reasons one can believe that the smartest and brightest technologists are not all moving to Alaska, namely that it's cold, right? So I think there's confounding factors, but there have been things that are directionally like a universal basic income that have already happened, again, in resource-rich countries, and those resources are the ones, is where the wealth is generated so that you can actually distribute it. And so I think that's always a useful question in all these evaluating something. When I do believe that, broadly speaking, and over any kind of medium period of time, there's generally not a free lunch in economics, right? Not generally. There's some edge cases. But so when wealth is being generated somewhere, the question comes, where is it coming from, right? The normal place it comes from is that people produce goods and services. Right? The total wealth of a nation is the number of people in the nation times how productive they are, plus the resources of that nation. And it's a huge oversimplification, but it's basically that. So this is why, then when you ask yourself, if you ask yourself, is wealth being generated? The question is, ultimately, someone should be producing a good and service in the real world, in most cases, for wealth to be generated. And it's also why, and this is not directly in the question, but since we spoke about central banks, and I think this is relevant to today's session, I'll discuss it. It's why central banks, modern Keynesian central bankers, are very concerned with unemployment. And it's not just that unemployment is a bad thing because the people who are unemployed are unhappy that they're unemployed, which that makes sense. I would be unhappy if I were unemployed. It's that there is a loss to the country's output. Every day someone's unemployed. And sometimes I like to simplify things in my head and imagine, like, instead of imagining the United States and it's 330 million people, and unemployment rate is 7.6%, and should it be that or 7.2%? And you can get yourself confused. Imagine that there was only 100 of us, and we lived on an island. Is there any chance we would be wealthier if 10 of us, the system decided, no, there's no work for you to do. You should just sit there, sit at home, don't work. Obviously, that's somehow a failure of coordination. And in a small group of 100 people, that would never happen. You would say, well, there's got to be something useful Antonis could do. Go pick some more coconuts. Let's build another house. Tutor the kids. Right? Because humans, at the end of the day, consume goods and services, not financial instruments. Right? Financial instruments are an intermediate piece. Ultimately, you consume goods and services. And so if you take 10 or 20% of your population and have them not producing any goods and services for your fellow citizens, every day that happens is another day, is another day when those goods and services were not produced, and that day is lost forever. You can't go back in time and be unemployed, re-employed in the past. So every day that Antonis Polemitis is unemployed, for example, and does not produce any goods and services, society that year has lost the production of Antonis Polemitis. Can't get it back. You might think, whatever, my production is good, bad, and different, but it's not zero. If nothing else, in the worst case scenario, I can move a rock from here to there. I can sweep a street. It's hard to believe that for any person who's in reasonable mental and physical health that their net contribution to society is negative. It's positive. And unemployment's even worse than that, actually, because long-term unemployment tends to have corrosive effects on the unemployed because they lose out on their career progression. So if there was Bob and Bob 2, and they're both 25 years old, and Bob 1 gets a job, and Bob 2 is unemployed for 2 years, and then gets a job, it's not just we've lost 2 years of Bob 2's output. We've also lost 2 years of Bob 2 learning to do things, getting trained. So it's when Bob 2 starts working, Bob 2 is going to be less productive than Bob 1 because Bob 1 has been doing whatever it is that they're doing, cutting hair, writing reports, driving a tractor for 2 years, and is better at it. They're more productive. Their output is higher. So you also lose, it's a cumulative effect, and you never catch it up. It's gone. That's just 2 years, it was always gone. And so it's why, this leads to the discussion of why economists had a absolutely viscerally negative reaction to Bitcoin. Because a lot of the Bitcoin community said, well, this is great, it can replace central banks, what have you. And modern central bankers felt that, these were the mistakes of the past in central banking, that you need to have hard money and be tough, and led to large sets of unemployment. And central banks don't just manage inflation, they indirectly manage unemployment. I mean, whether it's not in their mandate or not, it's on their minds, right? And so they say, well, Bitcoin's deflationary. That's bad. You're going to lead to unemployment, right? Why do they not like deflation? Well, story goes something like this. If I were sure that tomorrow the price of my, deflation says prices go down, right? So let's say my computer screen's 100 euros. And I knew tomorrow it would be 99 euros. I might say, you know what, I'll wait, I'll get it tomorrow. And tomorrow it's 99 euros. And I'll say, the next day it's going to be 98. Let me wait until it's 98. By the way, meanwhile, this is terrible if you're a manufacturer of computer screens, because the manufacturer is going to say, help, none of these are selling. I need to cut prices, otherwise I'm not going to sell anything. I need to pay my payroll. So they drop the price to 97. I say, oh wow, prices are really dropping. Let me wait a few more days. It's going to go to 95. And then they still don't sell. They cut it to 95. The manufacturer's getting desperate. His vendors are calling. They want to get paid. And so this ends up being this negative spiral where the net result is you produce less. That's why they want like slightly positive inflation. Like very high inflation is also destructive because you can't plan. You spend all your time running around trying to spend your currency before, or spend your money before it loses its value. But if you think prices go very slightly up over time, then you just have this counter pressure of like, yeah, there's not going to be much benefit if you wait. Go ahead and purchase something, and that stimulates more production of things. And I mean, there's a whole topic you could spend many hours arguing with kind of hard money folks and soft money folks on the other side, and they'll never agree. It's a religious dispute almost. But that is the general theory of why they dislike deflation. And so when people say, oh, Bitcoin's deflation, I say, well, that's terrible. We went through that. It caused a Great Depression. Why would we want to do that again? Now, I believe there is an easy solution to this. It doesn't matter if Bitcoin's deflationary if it's not the unit of account of a country. So, shares of Apple are also deflationary. But does that impact, what I mean shares of Apple are also deflationary? Over time, shares of Apple have gone up in price. And so if you priced cars, homes, computer monitors in shares of Apple, you would see their prices are going down. Because you used to need, 5 shares of Apple to buy a computer screen, and now you need 1 share of Apple to buy a computer screen. It's deflationary. Its price went up. But that doesn't cause these negative deflationary economic effects because you don't go to Best Buy or any other store and see TVs priced in shares of Apple. They're priced in dollars. And dollars are mildly inflationary, and so it doesn't cause these types of problems. Okay, well, that was a long answer, but I think we touched also on some other interesting topics that are in the presentation. Okay, now let's go to the next question. With all the recent talk by the IMF for the need for a new Bretton Woods type deal and increasing conversations about central bank digital currencies, will stablecoins still have a future? What happens with XRP and XLM? Parentheses. I am assuming there will be ramps from CBDCs to decentralized cryptocurrencies. When I think of a future where central banks trade money directly, likely pegged to some IMF global currency, I see some pros and cons. Are the assumptions below valid? And let me read the assumptions. Cons. A threat to privacy. CBDCs will likely drive out cash and our ability to transact privately. Con. A threat to freedom. If my money is centrally stored, then I give away control. My access to it might depend on behaving according to some strict rules. My ability to pay for things, travel, etc. might now be controlled centrally. Last con, automated tax collection. Pros. We no longer need commercial banks. Money is no longer created out of debt, fractional reserve banking, which in turn would mean that easy debt and loans are no longer pushed on society, making for a less consumerist-driven society. The 2008 crisis would likely have not happened if it wasn't for this debt-based monetary policy? If we no longer have a debt-based monetary system, what would CBDCs be backed by? It cannot only be gold reserves as to GDP, since that would put many countries such as the UK in a rather bad position. Could we dare to hope that Bitcoin becomes part of the basket of underlying currencies, underlying assets? Does any of the above make sense? Or are some of these assumptions too far-fetched? This is a complicated question. And the question starts one place and it goes other places. So let's start with where the question starts, which is, will stablecoins still have a future? I think that is an excellent question. I don't know the answer to it. But if you asked me, do I think sometime in the 2020s there will be central bank digital currencies for the main current national currencies, dollars, euros, yen, etc.? I think the answer is yes. So let me start with that. I think the answer is yes. Second, will these be competitive to stablecoins? I think the answer is also yes, because they will then serve the exact role of a stablecoin. And they will serve them with a superior value proposition. Right? Like, stablecoins today are kept stable by a variety of market or algorithmic mechanisms. A central bank, a Federal Reserve banked tokenized dollar would be extremely stable, because the Federal Reserve could say, and I'm not even going to SDRs and international currencies. Let's start with a simple case. If the Federal Reserve wanted a tokenized dollar, they could very easily keep the price stable, right? Like, they will buy or sell as many dollars on demand as needed at $1. And the only party who has no counterparty risk in creating or destroying dollars is the Federal Reserve. Whereas any stablecoin, there is some mechanism where it could go wrong. So I do think a CBDC, if you leave aside regulatory, if they want to crack down on cryptocurrency for regulatory purposes, just from a pure market competition perspective, a CBDC is definitely competitive to stablecoins. And you see that the central bank reaction to when Facebook said they're going to do some type of stablecoin, the reaction was very dramatic. Europe didn't like it, the US didn't like it. It felt like it was maybe coming directly on the central bank's turf in a way that a Bitcoin doesn't, because Bitcoin's not a unit of account. It has its own exchange rate, it has other pluses and minuses. But what it is not, and it's hard to imagine Bitcoin's a replacement for the euro, right? It's its own thing. So I do think it'll be competitive to stablecoins. I don't know. I don't have an opinion on XRP or XLM, even in the immediate term. It's a very complicated topic. That's a whole discussion of its own. But we'll now go from here to the questions of the pros and cons of CBDCs. Let's start with the cons, because I agree with all these. Is it a threat to privacy, and will they likely drive out cash, at least in some countries? Yeah, I think so. I think many governments, for better or not better reasons, would like there to be fewer cash transactions or no cash transactions. And it's one of those things where the benefits are obvious and the costs are less obvious. Right? The benefits are clear. People are going to say, well, I'm going to prevent money laundering. I'm going to prevent tax evasion. I'm going to prevent terrorism financing. These are all societal goods. Right? I don't think anyone's actually in favor of terrorist financing. The risks are less obvious and more extended. And the risks are that someday let's simplify it and call it, your political opponent gets a hold of this infrastructure and then uses it against you, not for those purposes, but for other purposes. Today it would be hard, whoever wins, a Republican or a Democrat, to say, I am going to freeze the other side out of the financial system. There's always the ultimate backup of cash, which is a bearer, decentralized, anonymous instrument, like Bitcoin. Right? More anonymous than Bitcoin. Bitcoin, let's say, is pseudonymous. Cash is pretty much anonymous. If you build a system where everything is trackable, it might be very good and very nice most of the time, until the day that it is not. And this, I believe, is a real risk of a system like that. And it is a genuine con of CBDCs. Threat to privacy, threat for freedom go together. Automated tax collection, I'm not sure it's a con. I mean, if you can, it might also, you could imagine some people saying it as a con and some people saying it as a pro. I mean, filing taxes is primarily a cost on society, right? Like the exercise of compiling and filing your tax return is a net loss. It's a transaction cost on society. And so if there was a way that my taxes were automatically calculated in the most favorable way to me based on the tax code at any point in time, and I didn't have to do it, I'm not sure it's a con. It might even be a positive. But I think others would worry that if taxes are so easy to collect, maybe taxes would go up. But I don't know, maybe the opposite would be the case. If you were able to collect, in some countries there's very low ability of the government to collect taxes. And so if it could collect a larger percentage of the taxes that it's owed, maybe tax rates would go down. So I think automated tax collection might become a thing, but I'm not sure it's a pro or a con. It could be either. It's actually hard though, right? Because if you take today's tax code, it's not just a matter of saying what transaction happened. You have to know what that transaction means to know what the tax effect is, and that's not totally trivial. And it's not clear that every transaction can carry that data along with the transaction. I'll try and make a simple example. Let's say I buy a chair. Well, it's a simple transaction, right? I spent $80, I bought a chair. If I buy it personally, it's nothing, it's an expense, and it's not tax deductible. If I bought it for a business, it might be tax deductible. It might be an expense. Or it might be something that it's an asset. You capitalize it, and then you depreciate it over time. So the expense shows up on your taxes over a 5-year period or a 3-year period. Well, whether or not your company's policy is to capitalize chairs and what depreciation to use and so on, is not necessarily embedded in the transaction of you and the chair seller. Right? You have to know a whole bunch of other things. So the system that could automatically calculate everyone's taxes might eventually exist, but it's a lot more complicated than just saying there's a CBDC. That is not enough to have automated tax collection. You basically have to have everyone's transactions and the metadata about the transactions and the policy data about the transactions on a unified system. Let's call it a blockchain. For that to be automatable all the way through. And I don't say it's impossible. It could happen, but it's also not imminent, and it's also not just CBDCs. It's CBDCs plus a whole bunch of other things. Pros. Not quite sure I believe the pros either, really. The main pros of CBDCs are all the pros of Bitcoin without the volatility risk. Right? You can do native transactions digitally, you can send money around the world instantly, you can programmatically handle money in various machines or IoT devices or your self-driving car. So I think those are the real pros. I'm not sure, and it's, again, these are each one of these a long topic. I'm not sure for that banks are the cause of the consumerist society, or that it's bad for society to consume. I'm not sure that's actually correct. And what I am sure of is there are a lot of opinions on that topic, right? Like it's a lot of countries want to increase consumption. So I'm not sure decreasing consumption is necessarily a good thing. And I would be surprised if a CBDC would have a private cryptocurrency at this stage as its basket. I mean, the big countries, the big currencies are pretty stable. They're backed effectively by the economic generating capacity of the country. And so if you have, I don't know, several $1 trillion of US dollars, which are a variety of digital formats already, and now you tokenize $100 billion of it, I don't think you need a new basket for that. Will someday some central bank buy Bitcoin? Well, as opposed to gold? Could happen. It could happen. Lots of things are happening now that would have seemed fantasyland 10 years ago. So it could happen. But I don't think it's something that needs to happen for someone to make a CBDC. They're different dimensions. Right? There's just a different dimension altogether. By the way, it's going to be a while, like central bankers, you hear this idea from non-central bankers. I don't think central bankers particularly love this idea. But it could happen in the future, you don't know. All right. Next question. On the money flower Venn diagram, this one, which you've seen, I think, in the materials, appear CB, central bank, digital tokens, wholesale, and CB, digital tokens, general purpose. Can you please explain in which ways do these differ and why? Yes. This is very straightforward. Wholesale tokens are in effect a settlement system for financial institutions. They are meant to replace or complement a real-time gross settlement system or a net settlement system or some other settlement system. They are a way for a limited set of regulated financial institutions, but maybe also large corporations or other organizations. But I think it's simpler to think of it as financial institutions, to agree how they will do transactions with each other, how they will settle their assets and liabilities among themselves. General purpose digital tokens are for everyone. So I can have them, you can have them, Citibank can have them, Federal Reserve can have them. They're like cash. They're not a permission, but there might be some KYCing to get on the blockchain, conceivably, but it's not going to be a requirement to say, in order to use this, you have to be a bank with $100 million of assets and blah, 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 regulated by the central bank and blah, 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 blah. It can be something that anyone can use, regardless of whether you're a financial institution. And there's also hybrid models that kind of blend the two. But I think this distinction is significant. I think you see different variations of this being discussed. You've even seen variations of this being discussed in the corporate world, right? All those permissioned corporate blockchains, consortiums, 10 financial institutions agreed they're going to use a blockchain to settle their derivatives trades. It's that same wholesale concept that basically it is an IT improvement, I think, more than a financial improvement. That instead of having to integrate a bunch of systems to speak to each other, we're just going to use this token. This token works in a standardized way, and then we can integrate our systems with the token. Whereas a general retail CBDC, it's got to be something that the average consumer can use. So I think that's the difference on those two. Okay, the last question, which I saved until last, because it is a segue to next week's session. With all the recent talk by the IMF for a new Bretton Woods, you see, it's all coming from the same place, different person asked the question. As France experiments with central bank digital currencies, CBDCs, using proof-of-stake blockchain Tezos, and the European Central Bank's Christine Lagarde mulls over the introduction of a digital euro, what impact will Europe's regulators play in the blockchain's expansion into financial sectors? Western authorities may also be putting their countries at a competitive disadvantage if they take too long to develop a coherent set of regulations. China, which has moved faster to develop a blockchain and cryptocurrency regulatory regime, is already testing its own own electronic currency. So here, anyway, I only have 6 minutes. Here I'm going to use it to segue into next week's session. Here we discuss the following. First of all, there are already a vast panoply of regulations that apply to even decentralized private cryptocurrencies. The idea that they are currently not regulated is incorrect. And while everyone hears the word regulation session and wants to run away and no one ever shows up to the video chat on the regulation session, I want to make the pitch that that's wrong. That's the wrong idea because of 2 reasons, a practical and a theoretical one. The practical one, you do not need to become a regulator of cryptocurrency, but you should understand enough about where it is likely regulated so you know what type of issues might cause you a problem as an individual. I think this is important. So you need to understand enough regulation to know when to call your lawyer. That's, I think, bucket 1. Bucket 2, and this is nerdy, but I think it's accurate. Bucket 2 is the transposition of existing regulations for the financial services industry and for currency in general into cryptocurrency is absolutely fascinating because it doesn't quite fit. Bitcoin's a currency, a commodity, an asset, is it a security? It's a little bit of all these things. And so when you're thinking about how do you transpose some of the thinking of the traditional financial system into this new financial system, it's very, very difficult and very, very interesting, and the trade-offs are very intellectually challenging and very sophisticated. And I dare say, and everyone's going to look at me funny, fun, enjoyable, intellectually engaging. So this is why you should come to next week's session. So in terms of where we are regulatorily, the US, I think, is, because it's unitary, is further along than Europe. Europe has different regulations in different countries, and they will probably harmonize by 2025. I don't know that China has moved faster to develop a blockchain and cryptocurrency regulatory regime. I think the regulatory status of private cryptocurrencies in China is and has been fuzzy the whole time. And it's one of those like running jokes in cryptocurrency of every year or so, the rumor goes around that China's banned Bitcoin again, right? And the reason these rumors go around is it's not 100% clear what the policy is. What China is significantly further along is its approach to its CBDC, which they've been working on for a while, as people have also mentioned in the chat. And that's something different, and of course it's regulated, but it's not even just like it's regulated. I mean, the rules of how that works are set by the people who made it, right? I mean, it's regulated in its own structure and birth and design. So I would say China is ahead on CBDCs. I would say between the US, Europe, and China, the regulations on private cryptocurrencies are least clear in China. I think they're furthest along in the United States just because at the federal level in particular, you have one person speaking for the whole, one agency speaking for the whole country, though there are distinctions on a variety of topics at the state level. In Europe, it's a mixed bag. There are some countries that have done a very nice job in making progress in this. A lot of countries that have done partial work or working on it. And some countries have done nothing at all. And meanwhile, there is a European Union community level effort to harmonize on certain topics, but not all topics. Like, for example, tax is not going to get harmonized. Tax is going to be a member state issue. And so I think Europe it'll be a few more years before one can understand what the treatment on certain issues is consistently across the EU. And even then, there's going to be further distinctions at the member state level on, at a minimum, tax policy. So I strongly recommend you also come to next week's session because I think it's super interesting and 100 times more interesting than it sounds when you hear regulation. Okay, everyone, so we have come to the end of today's session. I want to thank you, as always, for joining. I look forward to seeing you next week, and we'll talk about regulation then. Thanks a lot, everyone. Bye-bye.